Hello there. Welcome back to Grade 10 Accounting. In this video, we want to look at a past exam paper, and we are going to look at question 1 on that past exam paper. And this question has got 44 marks. Um, it's on analysis of transaction, that is the accounting equation, whereby we are going to analyze transaction and identify the double entry. After identifying the double entry, we also indicate the effects on the accounting equation. Right. The question reads, analyze the following transaction using headings provided, indicate an increase with a plus, a decrease with a minus, and no effect with a zero. Very important, when there's no effect, you're supposed to put a zero. Amounts should be reflected in the equation. The business is a favorable bank balance and uses a markup of 80% on cost price. Also, very important to take note of this markup because we know that we say cost price plus markup and you get your selling price. So in this, according to this question, our markup is 80%. And we know that the cost price is always 100%. And then obviously the markup and the selling price are the ones that changes, but the cost price is fixed. The percentage is always 100%. And what we are saying is cost price should be 100%. Then markup depends with what the question is saying. In particular, this question is saying 80%. So it means our selling price is now 100 plus 80, which is 180%. So let's take note as we go. Right. As we go, the question we see that we are given transactions now, and we are given an example that is bought stationery on credit from the supplier. That is ZZ Stationers with 500 rands. So obviously, this will be given on the answer section in terms of how we are supposed to go about the answering. So if you go to the answer section, let's try to see. You see they've given an example where they are saying the source document of that transaction is original invoice. Then we state the account debited stationery, account credited creditors control, and then if you know the accounting equation, the owner's equity is there's a minus 500, and then on liability there's a plus 500. So this is the example that we are given. Then we go to our transactions now. First transaction reads paid weekly wages by check 2,400. So we have to identify the double entry first. So when identifying the double entry, let's try to identify where the movement of money. Remember the basic concept of double entry, which says we debit the receiver, we credit the giver. So the movement of money determines which account is going to be debited. If the transaction has got money, it means it's a bit simple to deal with. For example, here we are saying we paid weekly wages, so we are paying using check. So money is going out of the business. So it means the money is the giver. So our check is going to be the giver. And whenever we have check, we are going to open a bank account. So it means we are going to have our bank. And also we are paying wages. So it means we're also going to have our wages account. So basically now we are saying money is moving out, which is in the form of bank. So we credit the giver. So we credit our bank. And then wages we debit. It automatically it means we debit. And we should know that also we should abide by the principle, a double entry principle, which says every debit entry has got a corresponding credit entry. We don't debit and debit according to double entry principle. We debit in one account, then we credit the other. Every debit entry has a corresponding credit entry. So we have debited, we have credited. So that's a complete double entry. So this is what we have. So we are just going there. The amount that we have is 2,400. We are just going there and first of all put our double entry. Then we identify now in terms of the effect now on the accounting equation. So if you come here, we are saying and then this one, remember, it's a check. So it means our source document now is going to be a check counter for. Check counter for. This is going to be our source document. And then account debited, remember, we have already identified that it's wages. account credited, I will say the bank. So having done this now, we can start by wages and try to identify on the accounting equation what is being affected by wages. We've got assets is equal to owner's equity plus liabilities. This is the accounting equation. So here we can put a line whereby we are saying this side is equal, which is assets should be equal to the total of owner's equity plus liabilities. So what we should know here is that this side, whenever we have a plus, this side of if your double entry is affecting assets, for example, and owner's equity. If there's a plus here, it means owner's equity should also have a plus, so that after the effect, the two totals for both sides, this side and this side, should be equal. If the transaction is affecting, for example, assets and liabilities again, we should have a plus on assets and also on liabilities, having a plus. That's the issue. And if it's a negative, it means if it's a negative on assets, it's also going to be a negative on owner's equity. If it's affecting assets and owner's equity, the same applies. If it's affecting assets and liabilities, it should be minus and minus. But if it's affecting one side, let's say the transaction is only affecting assets. The transaction is, the two accounts are part of assets. It means we are going to have a plus and a negative on one side, so that the total comes back to the original position. If it's 500 and the effect is 50, we are going to say plus 50 minus 50. It will go back to what? To 500. It will remain the same as the other side. If the transaction, for example, is affecting owner's equity and liabilities, it means on owner's equity, we might have a negative, in liabilities a positive again, because it should come back to the same position so that it becomes equal to the other side. So this is what we have. So let's try to identify according to our transaction. We have got wages. So wages, we know that wages is we charge them in the profit and loss account under less expenses. So they are going to reduce the figure for net profit. So net profit, we know that is part of owner's equity. Net profit is part of owner's equity, and it increases owner's equity. So whenever there's a reduction on profit, it means the owner's equity also is going to reduce. So in this case, we've got wages that is reducing the net profit. So it's also going to reduce the what? The owner's equity. So you're going to have a negative 2,400 on owner's equity. And we are seeing that this transaction is affecting two sides: owner's equity, the other side, and the side of assets. So we are having a negative here. We are having a negative here on owner's equity. So we are also going to have a negative on assets. So we are crediting bank, and we know that bank is a normal debit balance as an asset. So when you credit an asset, it's a negative. So here we are also putting a negative 2,400. So this is what we have on the first transaction. Then we can go to the next one. On the next transaction, now we are now on transaction 2, which is saying bought trading stock for 380 rand and paid out of petty cash. Bought trading stock for 380 rand and paid out of petty cash. So we are also trying to identify which account are we debiting, which one are we crediting. So we bought trading stock, which means trading stock, we are receiving trading stock. So obviously we are going to debit the trading stock account. So it's going to be a plus on trading stock. And then we paid out using petty cash. Petty cash is an asset again. It's a current asset. So money is going out. So we are crediting at the petty cash account. So basically our double entry, we are saying we are debiting our trading stock, and we are crediting petty cash account. So this is for a start, we can go and put the double entry, and then we try to identify in terms of the effect on the accounting question now. So the amount that we have is 380, so we can just go there. So if you come here, you would see that our our source document is going to be a petty cash voucher. Whenever we pay using petty cash, the source document is petty cash voucher. So here we are saying petty cash voucher. Then the account to be debited, we said we are debiting trading stock. And the account to be credited, we are crediting petty cash. And then the effect on the accounting equation now, let's start by trading stock. Trading stock is an asset, so it's going to have an effect on assets. And then we are debiting it. And whenever you debit an asset, it's a plus. So we're going to have a plus. The amount that we have is 380. But also we have petty cash also being an asset. And we are crediting an asset. So whenever I credit an asset, it's a minus. So we are having minus again on assets again minus 380. So this total on the side of assets is not going to be affected. It's going to same position. So this is what we have in terms of the second one. So what we should know also, maybe we can just try to give a breakdown in terms of when we have an asset account. The debit side, when we debit an asset, it's a plus. We credit the negative. Then when we have a liability account, when we debit a liability account, it's a minus. When we credit, it's a plus. As simple as that. So it becomes opposite when we go to liabilities. So we can just maybe try to take that down so that it doesn't confuse us. So when we come here now, we are going to the next transaction, which is on transaction number 3, which is saying sold goods on credit to L Molala 2,700. Double entry, we are selling goods, so they are sales, but we are selling on credit. So we are going to open the name of the person, which is L Molala, and it becomes a what? A debtor. So the debtor's control is going to be debited, and then we credit sales. Remember, sales account is always credited. Whenever you see sales account, it means you're going to credit it. That's a very simple that. Then we go to the other section and try to summarize that. We come here and we are saying we are selling on credit. So obviously there's an invoice that is involved. And also, whenever we sell goods, it means we are going to have 2 double entries. Because remember, we have got cost of sales. We have got cost of sales. We have got goods in our trading stock account that are being sold. So we need to remove them in our books again. So we have got 2 double entries that are there whenever we sell goods. So let's start by putting the first double entry. And remember, we are saying the source document is the invoice. And so we are going to have a duplicate invoice. Duplicate invoice as our source document. And then we are saying account to be debited, we've got debtors control. Debtors control, let's just try to make it fit there. We are saying debtors control. And then account to be credited, we have sales. Then on the amount now, we take the amount that we are given as the selling price. Remember, we are given the selling price as 2,700. So we are taking 2,700. 2,700. So we are debiting debtors control, which debtors control is an asset. So when you debit it, it's a plus. So we are going to have a plus 2,700. And then we are crediting sales. Sales is adjusted in the income statement there in the trading account where we say sales, and sales increases the net profit. It's a plus net profit. Remember, we credited it in the trading account. So it's going to increase our net profit. So when since it's increasing our net profit, it also increases our owner's equity. So the other section that is going to be affected is owner's equity, and we are saying it's a plus again. Then we go to the second double entry on that transaction. We come back that we sold at 2,700, but we need to remove the goods that we sold. They are inside our books in the trading stock. So to remove them, we should remember at first when we recorded them in our trading stock account, we recorded at cost price. So but the figure that we are given is selling price. So you need to find the cost price first, and then we do the double entry using the cost price. So if you come at the beginning of the question, we are told that 80%, there's a markup of 80% on cost, which means these goods were 100%. Their price being the cost price is 100%, and then a markup was added of 80% to become 100%. That's the 2,700 that we have. So basically what we are saying is the 2,700 that we are given is 108%. So we are saying 180% is equals to 2,700. So the figure that we are looking for is 100%. 100% is the figure that we are looking for. So simple proportion there. We are saying what we don't have is 100, so it becomes the numerator. What we have is 180, so it becomes the denominator. Then we multiply by the given figure, 2,700. As simple as that. Then we calculate it like that. You would see that we are going to get 1,500. We are going to get your 1,500. So we can try to verify that calculation. Let's try to see. We say 100, and then we divide by 180 and try to see what. So after this calculation, we see that 1,500 is the correct answer that we have there. So this is the one that we are going to do a double entry for cost of sales. So the double entry now on this cost of sales 1,500, we are going to debit cost of sales, and I will remove them. Remember, in the trading stock, they were in the debit side. When we bought the goods, we debited the trading stock account. Now we are removing them in the books. We go to the opposite side, credit side, and enter 1,500, and then we debit cost of sales. So this is the double entry that we are going to use there, and the source document is still the same, which is the duplicate invoice. So we come here. We are saying account to be debited. We are saying it's cost of sales. Account to the to be credited, we are saying it's trading stock. So cost of sales, we know that cost of sales, we find cost of sales in the trading account, so it's going to affect our net profit, and it's going to reduce our net profit. So the owner's equity is going to be a negative 1,500. And then the other effect is on the trading stock, and the trading stock is an asset. We are crediting it. Whenever I credit an asset, it's a minus 1,500. So this is what we have. And let's not forget to put our zeros where there's no effect. Remember the instruction of the question. So it means here we are going to put a 0, here a 0, here a 0, here a 0, and here also we are going to put a 0. Wherever we don't have any effect, we are supposed to put a 0. So we go to the next one, which is now item 4. So on item 4, what we are saying, bought equipment on account from Sally Traders for 10,800 rands, less 15% trade discount. So we have the element of trade discount that is in this transaction. Remember, trade discount is not shown in the books of accounts. So we just remove it and ignore it. So what we are going to do is here, this figure that will be given will be 100%. Then there's a less 15%, so we are subtracting 15%. So it becomes 85%. So the figure that we want is 85%. So we are just going to say 85% of 10,800. So we are saying 85%, which is 0.85 as a decimal, and then we multiply by 10,800 rands. It would see that the figure that we have, there is going to be 9,180. We can as well try to verify that calculation. by saying 0.15 times 10,800. Sorry, 0.85, and then we multiply by 10,800, and then we are going to get your 9,180, which is the figure that we have here. So this is the figure. So on double entry, we are buying equipment, which is equipment, we are receiving equipment in our business. So obviously we are going to debit our equipment account. Equipment is a non-current asset account. It's an asset account. And then it's on credit. It's on account, which means it's on credit. When they say on account, it means that it's on credit. So it means we are going to credit the creditor's account, because there's no cash or a check or a bank movement there. So it means we are going to credit our creditor's account. So that is the double entry. So we can go there. And we know that the source document obviously is going to be an invoice again, since it's on credit. Right. So since we are not buying goods, when we buy goods, we are supposed to have an invoice. So in this case, we are going to have an original invoice. So we are going to have an original invoice here. Here's our source document. So we are just saying original. Invoice. Then on the double entry, we said we are debiting equipment. And then we are crediting creditors control. And we removed the trade discount of 9,000 of 15%, and we left with 9,180. So on the effect now, we start with equipment. Equipment we have debited is an asset, so it's going to be a plus 9,108. Then the creditors control, we have credit again, it's a liability. Creditors control is a liability, and when credit liability is a plus again. So we go to the liability section, and we have a plus 9,108. And obviously no effect on owner's equity, so it's a 0. So go to the next one, which is the fifth one. So on the fifth one, now we are saying, let's try to just remove this, and then we go to the fifth one. Right, on the fifth one, we are saying charge the interest 5% per annum on a Mahlangu overdue account of 4,200 rands for 4 months. But the issue is there's an interest that is being charged there. We are charging an interest, so we are receiving the interest. So you're going to have an interest income account. And we are charging on a Mahlangu. So it means this one is a data. Supposed to pay us the interest, so it's a data. So we are having a data's control. We are having data's control, and we are also going to have interest income. And obviously, this is going to increase the amount a Mahlangu is owing. So we debit the data's control, and all income accounts are credited. This is an interest income account, so it's an income account, it's credited. We know that all income accounts are credited, then expense accounts are debited. So here we credit here. Then the amount that we have, the amount that we are supposed to put there, the amount is the overdue account is 4,200, and the interest is 5%. So basically we are saying 5%, which is 5 over 100 times 4,200. And we try to calculate that one. 5 which is 5% is 0.05. Then we multiply by 4,200. And you're going to get your answer there. 0.05, and then we multiply by 4,200. So here we are going to get your 210. So this is what we have. So we just go there, and put our double entry. That was on the item 5. And remember, the source document that we are going to use there is the journal voucher for that interest. Journal voucher. And the account to be debited is debtors control. And the account to be credited is interest income. And then on the amount, remember, the amount that we got is 210. And when we debit debtors control, it's an asset, it's going to be plus 210. And interest income, we adjusted under other income in the income statement, so it's going to increase our net profit, so it's going to increase also our owner's equity. So it's a plus 210 on owner's equity again. So this is what we have. Then we don't have any effect on liabilities, so we are going to put a 0. Then we go to the last one. So on the last one now, we have received 1,800 rands from Emradu on his account, allowed him 30 rand discount. Received 1,800 from Emradu on his account and allowed him 30 rand at discount. So what is going to happen there is we received 1,800. So obviously we are going to debit our bank with 1,800, and then Emradu obviously is a debtor. So whenever a debtor makes a payment, we credit the debtor's control. So we credit debtor's control and debit bank. But also there is a discount that is there of 30 rand, which was allowed. So what are we going to do? We are also going to have a discount allowed account. Discount allowed account, which we are going to debit. Because discount allowed is an expense, we debit. And then we credit now the debtors control. We credit there. We credit the debtors control, and with what? With 30 rand. That is double entry for the discount. So, but for the 1,800, we are saying we are debiting bank and then we credit debtors control. So this is double entry that way. So let's just go there and then identify double entry consent. So we come here. We are saying the first double entry, we are debiting bank. And then we credit debtors control. Then we check on the effect on the accounting equation now. The amount is 1,800. So by debiting bank, it's an asset that has been debited, so it's a plus 1,800. Then by crediting debtors control, it's an asset again, but when you credit an asset, it's a minus. So again, minus 1,800. So this is what we have. So here we've got 0, 0, no effect. Then the second double entry, remember, we said we've got a discount allowed. Discount allowed that we are debiting. And then we are crediting debtors control. And the amount is 30. But when we debited discount allowed, it's an expense, it's going to reduce the net profit. So it's a minus on the owner's equity here, minus 30. And we credit the debtors control as an asset. When we credit an asset, it's a minus, so it's a minus 30 again. So this is what we have. So this was the last transaction that we have. And then on the last part there's no effect, so you're going to put a 0. So this is what we have, guys, according to this question of analysis of transaction. But basically, it's a question that is in particular concentrating on double entry and effect on the accounting equation. So hopefully this video was helpful. Those who haven't subscribed, please subscribe, and please share the link to all your friends that are doing Grade 10 accounting. for the assistance of the exam that is upcoming. Let's stay tuned for more videos. Let's keep notified. As for this video, I'm signing out. I will meet again in the next video.